If you don't know how to read a chart, count pips, or calculate your profits, then you're in for a lot of trouble. I'm going to use this video to show you how we're able to count pips and exactly how we determine our profits before we even enter a trade. Because let's face it, guys, you don't want to be like this guy. Now, in order for me to fully explain this concept to you guys, I'm going to enter a trade into the demo account that we created in the previous video. So I'm going to go ahead and do this now. Enter a trade here and new order. And for this one, I'm going to do one lot. I'm going to leave it 1.00. I'm going to leave it in instant execution. And I'm going to go ahead and hit sell. And you'll notice whenever you enter a trade, you're always going to be in a negative. You're always going to start off in a loss. You'll notice here I'm $16 currently in a loss. And the reason that is because whenever you enter a trade, you're always going to be entering on one of these two lines. Now, whenever you enter a sell, like in this case, the market is always going to enter you in that trade on that blue line at the bottom. So you're always going to be entering that blue line, and you're going to remain in a negative until that red line crosses below your entry. You'll notice the farther up the price goes, because I'm in a sell right now, the more negative I'm going to get. The farther down the red line gets, the less negative I'm going to get. And at that point, when that red line crosses below my sell point, when that red line goes below my sell point, at that point, that's when the trade will finally enter profit. And anything below that, as the chart continues to go down, it will continue to be more profits the farther down the candles go. So as you can see right now, the red line still has not went below my entry. It's still currently in a negative here. It's almost getting out of the negative because it's slowly creeping down. And you'll notice finally got out of the negative, continuing into the profit. Why? Because the red line is now below the entry. Now that the trade is running, let's go ahead and get to the good stuff, right? The sweet, sweet cash. Now, whenever you're looking at a currency pair, so for example, this one here, we're looking at Euro USD. Whenever you're looking at a currency pair, the left currency, for example, Euro, or the base currency, is always going to be compared against the quote currency, or the currency on the right-hand side. So the way you want to think of this is 1 euro is equivalent to X amount of US dollars. So in this case, the current conversion rate right now is 1 euro is equivalent to 1.21327 US dollars. Now, whenever we're actually counting pips, though, we want to ignore the fifth or the last decimal place. So you want to ignore the last decimal place whenever you're considering counting pips. So I just want to give you a quick little example here. Let's go ahead and take this price as the example, 1.21000. So remember, whenever we're counting pips, we always want to ignore this last little digit here. That fifth decimal place is called the pipette. So the pip decimal place is going to be this fourth decimal place. So my question to you is, if this decimal place is the pip area, if the price goes up by one single pip, what would that new price be? Ignoring the zero, this new price would be 1.2101. That's what the price would be if it goes up by 1 pip. So what would happen if this goes up by 10 pips instead? The new price would be 1.2110, which is 10, right? And if this price goes up by 50 pips, this would be 1.2150. So the question becomes, what happens if the price goes down by 1 pip? The new price would be 1.2099. So think of it just 100 minus 1, which gives you 99. So what happens if this price goes down by 50 pips? The new price would be 1.2050. 100 minus 50, right? And if this goes down by 100 pips, you would consider this as 1.2000. So you would always look at the second to last decimal place whenever you're counting the pips to determine how far up or down the price has moved whenever you're dealing with a currency pair that is not a currency pair that is a Japanese yen. So for example, I want to show you a currency pair USD JPY. and I want to show you this. This doesn't go up to 5 decimal places. This only goes up to 3. So the same concept here, a little bit different, simply because this has a JPY in the currency pair. Same concept, but this time we're ignoring the third decimal place. So this last digit here, that would be considered the pipette. So if you take a look at this number here, if this price goes down by 7 pips, the new price would be 104.60. And if this price goes down by 10 pips, this would be 104.57. And if this price goes up by, let's say, 20 pips, this would be 104.87. You want to ignore that last decimal place. So just to give you an example, Euro USD, I'm going to take this little measuring tool and show you. I'm going to line this up with 1.2100. And I'm just gonna move this ruler tool around so you can see. By the way, right above my cursor, you can kind of see it says 12.0. That shows you the amount of pips that I'm currently measuring up and down. Notice that number is constantly moving up and down. So if I measure 10 pips up, you'll notice on the right hand side the new price is 1.2110. And you would just ignore that last decimal place. And again, if this goes up by 50 pips, the price would be 1.2150, just 50 pips up. That's kind of how you would calculate how far up or down the price has moved. Now, one thing I want to show you is going to the daily time frame. I want to show you how volatile these pairs are, essentially on like a daily basis. So I want to show you by going to the daily time frame, each of these vertical bars, each of these Japanese candles that you see here, each of them represent essentially one day. I'm going to get this little measuring tool. I'm going to measure from the top of the day all the way to the bottom of the day, and we're going to calculate and see how much this pair moved in one day. This moved 61 pips in one day, and I'm going to explain how these pips kind of benefit us here in a little bit. But notice it moved 61 pips today. And yesterday, the same exact pair moved 62 pips. But the day before, this same pair moved 110 pips. So each day, the pairs move up and down, and the volatility is represented by the number of pips that the currency itself moves. Now, Euro USD, it is the highest volume traded currency pair. So this currency pair is one of the least volatile pairs you can possibly see. And as traders, we like volatility. We like to earn all the pips moving up and down, as long as we're in the right side, as long as we're in the right direction. So just to give you a quick example, looking at GBP for example, you'll notice this pair is a little more volatile. So I'm just gonna take this little ruler tool. I'm gonna measure from the top of the day all the way to the bottom of the day. This pair here moved 160 pips in one day. And the previous day, this pair moved 118 pips. Now, the day prior to that, this pair moved 187 pips. So this pair, for example, is a lot more volatile, meaning if you are on the right side of the trade, meaning if you get the trade right, those are a lot more pips you'll be able to make. Now, if you remember a few minutes ago when I entered the trade on my phone, I left the trade size as 1.00. Now, that is called one lot, or in other words, one standard lot. Now, by trading one standard lot, what you're essentially doing is you're trading 100,000 units of that currency. So that 100,000 units is considered one standard lot. Now, you can trade smaller than that. And if you do, that is called a mini lot, which you're trading 10,000 units of the currency, which in MetaTrader 4, you would type 0.10. And if you want to trade smaller than that, you obviously can, and that would be labeled as a micro lot, or how you would type it on MetaTrader 4 would be 0.01, and that would be trading 1,000 units of currency. And by the way, you can trade any number in between. By the way, you can trade 0.24 or 0.25, and that will just calculate based on whatever you're measuring. So for example, 0.25 would be 25,000 units of currency, or 2.5 would be 2.5 lots, Or in other words, you would be trading 250,000 units of that currency. Now, what I want to explain here is when you're trading one standard lot size, how I explained these pips earlier, each pip that the price goes up or down at one standard lot size, you're going to be making or losing $10 per pip. Now, if you're trading a mini lot or 10,000 units, or if your lot size is 0.1, each pip that the price moves up and down, you're going to be making or losing $1 per pip. And if you traded a micro lot, or in other words, 0.01, then you're going to be making or losing 10 cents per pip. And by the way, you can do anything in between. So for example, if you're trading a lot size of 0.5, you can think of it as half of a lot. So if one lot is $10 per pip, and this is half of a lot, you're essentially making or losing $5 per pip. So the reason why I explain this is if you trade, for example, a one standard lot size and you're trading this currency pair, GBP NZD, and you notice this currency pair moved 160 pips, then you'll know that if you traded one standard lot size, meaning each pip you'll make or lose $10 per pip. So if you made your trade betting that the market is going to go down starting here all the way to down here, 160 pips at one standard lot size, that is $1,600 that you made on that trade. And the same thing the other day. So if the previous day you traded starting from down here looking to go upwards, and you notice that the price started here and the highest it went in that day was up here, 116 pips. If you traded at one standard lot size, that would be $1,169 that you made on that trade, which is, we just took the number of pips and just multiplied it by $10 per pip. So if you traded a mini lot, since each mini lot is just $1 per pip, this is a $116 trade. Or if you traded a micro lot, just move the decimal place over one time because it's 10 cents per pip. 116 pips times 10 cents, that's going to be $11.69 on that trade. That's how you kind of determine how big you want to risk, how small you want to risk based on the lot size that you're going to be trading. So you can notice there are many opportunities in the markets. As long as you're right, you'll be able to make some very good money as long as you're properly doing your risk management and as long as you're trading in the right direction. So for example, on this day, starting from here, ending at the top of the day, which is right over here, this is 184 pips. Or at one standard lot size, this would be a $1,800 trade. Now, again, with Forex, you can hold your trades open for more than one day. So if you held this trade open starting from here and you had and you made a bet to go upwards and you wanted to enter a one lot trade or even a two lot trade, you would enter your trade and you would count the number of pips that the price went up and you would just calculate your profits. So this would be a 500 pip trade. Calculating this at $10 per pip, this would be a $5,300 trade that took 12 days to complete. And if you did two lots on this trade, this would be $20 per pip. So 20 times 500 pips, that's a $10,000 trade. That's how you're able to scale up as your account gets bigger. So of course you're not going to be doing a one lot trade when you're beginning. You're of course not even going to be doing a two lot trade when you're beginning either. But once your account size grows, your lot sizes will automatically start growing as well because you're going to be trading based on a percentage of your account. And here's the thing, the more opportunities you can successfully spot in the markets to be able to catch these pips on these different swings up and down, the more money you're going to end up making at the end of the day. or even at the end of the week, or even at the end of the month. So if you can locate and successfully find these little pinpoint places to enter the market, and if you can make 20 pips or even 50 pips or even 100 pips on a trade, you're going to be consistently making money and being able to minimize your losses. So here at Market Makers University, we don't focus on 20 pip, 30 pip trades. We focus on the trades a lot bigger than that. So if you can focus and pinpoint various different ways to enter into the market, you analyze the charts and you'll notice you'll be able to find these swings where you're entering 275 pips in a trade, or even 170 pips downwards, or even 170 pips going back up, or even 100 pips going back down, and then 100 pips going back up, and then even 160 pips going back up. These are the type of trades. This is the strategy that we teach here at Market Makers University to our private students. So if you haven't booked a call already, I would definitely suggest book a free call. There's a link at the bottom in the description. So go and book a free call. We'll take a look at where your current situation is. We'll take a look at where you are currently at in your trading career, and we'll see if we're a good fit to be able to work together. Now, to bring all of this home, to put it in a real life scenario, to tie all of this stuff together, I'm going to be going back to the trade that I opened earlier, and we're going to kind of explain that concept in the actual app itself. You'll notice we entered the trade at 1.21344, and the price is currently sitting at 1.21327. So we need to figure out how many pips did the price move from our entry to where the current price is sitting at right now. So how do we do that? It's very simple. You just find the difference. 1.21344 minus 1.21327. And you'll notice the price moved by looking at the fourth decimal place. The price moved 1.7 pips. 1.7 pips. Because remember, the fourth digit is the pip. So if the price moved by 1.7 pips and we entered a one lot trade, that means we entered a $10 per pip trade, and each pip is $10, and this price moved by 1.7 pips. How much profit did we make on this trade so far? We made $17 profit on this trade. So what happens if this trade moves by, let's say, 20 pips? We made $200 on this trade. If this trade moves up by moves in our favor by, let's say, 60 pips, we made $600 on this trade. That's kind of showing you how you're able to calculate how much profit you'll be making based on reading the numbers and understanding the concept behind how all this stuff works. So I want to explain something to you. If our account is $10,000 and we're willing to risk 2% of our account in order to enter this trade, we need to understand how much money we are willing or ready to lose. So we take $10,000 and we're willing to risk 2% of that, which is $200 that we're willing to lose. So we need to figure out how far can the price go against us in order for us to lose that $200 maximum and just cut our losses from there. So how do we figure this out? We entered a one lot trade, and we're ready to lose $200 if we're wrong on this trade. So we would need to figure out how many pips that would be going against us. We know that we entered a one lot trade, so that's $10 per pip. In order for us to cap out our loss at $200, the trade would need to go 20 pips against us, and we would need to cut our losses there. So what would we do here? We would need to go ahead and figure out what is 20 pips above the price that we entered, because we entered a sell. So how far up must the price go in order for us to lose that $200? So we know our entry price is 1.21344. So we need to think about what the new price would be when this pair goes up by 20 pips. So ignoring that last digit, the fifth decimal place, we need to figure out 20 pips higher than this. So 34 plus 20 is 54. And you would go ahead and add that last digit back on there. So our stop loss would need to be this value here. Once the price reaches up this high, our trade would be in a negative $200, and we'll just cut our losses from there if we're wrong on the trade. So how do we do that? We would go back into the trade. We would modify the trade. We would go ahead and go to this little red area, the stop loss area, and we would go ahead and type that number here, 1.21544. And that would be considered a 20 pip stop loss for this trade. So at this point, you should be able to fully understand how to read the prices on the chart. You should be able to calculate your pips. And most importantly, you should be able to understand how to calculate your profits and how to calculate your stop loss to be able to prevent any further losses from occurring. So this way you can understand exactly how much money you'll make on a trade before you even go ahead and enter a trade. Now, bonus thing I want to quickly do for you guys. I want to ask you guys a question. Now, I want you guys to leave this answer in the comments below. I want to see who's paying attention here. So I want you guys to look at that red line and that blue line, the bid and the ask price. So the area in between is called the spread. So my question to you is, and leave it in the comments below, I want you guys to tell me right now at this very moment, what is the spread? How many pips is the spread? Or in other words, how big of a gap is there in between the red line and the blue line? How many pips of a difference is that? So go ahead and leave that answer in the comments below. I'm going to be reading the comments to see who's paying attention, to see who understands this fully. And again, if this video did provide some value to you, go ahead and feel free to hit that like button and punch that notification bell right in the face. And go ahead and subscribe if you haven't already to be notified whenever I upload any more videos. So other than that, I'll catch you guys in the next video. Take care, guys.